Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending September 16th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is how low can we go? Or in other words, are we going to make new lows? Well, let's just kind of take a look at where we've been and what everything seems to be suggesting as we look at the markets. If we look at this past week, as you can see in the US, everything was very solidly in the red. Again, after a strong prior week, everything finished hard in the red, almost 5.5% for the NASDAQ. Everybody else over 4%. In fact, there was not one US sector that finished in the green for the week, the worst being materials. They tend to be a little bit more economically sensitive to higher rates. They came down very hard. You can see performance year to date. Energy still leading the way as it has from the first week out of the gate all year long, up 44%. Communication services fell 32.55% for the year. If we look at the PE ratio, you can see the trailing is 21.49, the forward is 17.48. I still believe that's going to come down a little bit more with the rate rise that I'll be talking about in a minute coming up. I can see that falling back into the 16s again. Dividend yield 1.66%, 10-year treasury finished higher over the dividend yield by 179 bips. That's 1.79%. It's at 3.45%. Earnings yield, the S&P still at 5.72%. You can see the yield over the 10-year treasury is 2.27, but the real yield is still negative. That's the key. Inflation is very strong, folks. And with that real yield negative, the Fed still have more work to do. In the current VIX, it closed up 13% for the week. Not really crazy. I mean, it's just been an orderly move. What's happening is markets are being revalued, and we would expect that with interest rates running higher. In fact, we had this weekly drop was one of the worst we've seen going back to the summer of this year. Okay. Trading volumes were also relatively light. Number of shares traded coming in well below the average. We did what really moved the markets. Monday started out okay, but then the Tuesday CPI data came in above expectations, dashed any kind of hopes that investors had that the economy has moved beyond peak inflation. I mean, headline prices rose 8.3, but the core jumped to 6.3. That's what the Feds use, and that just got everybody all in a tizzy, right? It's the highest level we've seen since March with the core inflation. PPI also came in somewhat lower, but still very, very elevated, all right? Treasury yields continue to push higher. Short, intermediate term maturities all showing higher. Expectation for a rate hike coming up this next Wednesday, 75 basis points or 0.75% of a rate hike. In fact, there's over a 20% chance of a full 1% rate hike. Okay, so that's really amazing. This would be 3 in a row, right? Now, the 2-year treasury actually traded around 3.9% early Friday morning. It's the highest level we've seen in the 2-year treasury bill in 15 years. All right, just really through the roof. Now, if we look at across the pond and look at the European markets, again, everybody in the red for sure. DAX, CAC 40, FTSE, Euro stocks, all solidly in the red. Year to date, solidly in the red. The FTSE's the only one that's barely hanging in there at 2%. Japan, they're not going anywhere, but the FTSE 2%. We did get a small reduction in UK inflation. It came in at like 9.9% in August. That was down from 10.1 the prior month, July. British pound going down against the dollar. The dollar is very strong. It's up over 13% year to date against other currencies. We're already at euro parity, meaning the euro is less than 1-to-1 for the dollar. I hadn't seen that in 20 years. Simply because the U.S. is the only economy worldwide that seems to have some sense of stability in it, although it's coming down hard. It's not as bad as the rest of the global planet right now. But like I said, inflation came down just a little bit over in the UK. The British pound, by the way, is depreciated against the US dollar, sinking the lowest levels it's seen since 1985. All right. And we're seeing the Bank of England is probably going to get more aggressive and hike their rates another 50 basis points at their next meeting. So we got a lot of that going on. And meanwhile, over in the rest of Europe, they're getting ready to prepare for a winter. Hopefully, it won't be too cold for them. But they're going to raise about an estimated 140 billion from energy companies as an extra tax to soften the impact on their soaring energy costs. And they're going to go after. They're going to put a cap on revenue of non-gas power producers. They're going to try and reduce electricity demand. So it's going to be really a crazy winter all across Europe. Okay. And then, of course, if we look at the Asian markets, let's get down there, take a look at them. In the Asian markets, you can see trade data in Japan, it did grow 22% from August 2021, primarily because the economy in Japan is opening back up. So there's a lot of post-COVID bounce there. Japan's top export market was the U.S. So the consumer is still spending in the U.S., although that spending level is slowing down. And the other currency that's very weak against the dollar is the yen. It's finished at 142. All right, and the Bank of Japan is even talking about, rumor-wise, that they would intervene in their currency. All right, last time they did that, it was decades ago when the yen was at 148. So they're around those levels where Japan may take some action. Then, of course, if we go over to China, you can see both China and Hang Seng, which is Hong Kong, both finished solidly in the red this week. Year to date, not doing very well either. China had better than expected factory growth. And the industrial production rose a little over 4% year over year, but they're opening back up again, just like Japan from COVID. So they're having some betterment there, but it's mostly a post-COVID bounce. However, their property sector is extending their slump. New home sales and prices in 70 cities across China fell in August. That's the 12th straight month of falling. So they're really having a hard time of it. Over there. So basically, the U.S. is the only pig in the pen right now with lipstick. It's looking okay. The dollar against a basket of other currencies is up 13% across the boundary here. But this next week is going to be very, very interesting with the Feds coming up. I mean, we got to be very careful. Current Fed funds rates at 2.25 or their benchmark rates at 2.25 to 2.5%. The markets are pricing in by December that number going to 4 to 4.25, or even some saying 4.25 to 4.5. So either way, we're looking at a rate hike between now and the end of the year of an additional 1.75% to 2%, which would imply a 75 basis point rate hike this coming Wednesday, and then probably a 50% or 50 basis point rate hike, and then another 50 basis point rate hike. So those are very, very strong, giving us a terminal rate by December of 4 to 4.25%. All right, the terminal rate was 3.75 just a month ago. So you can see that additional 25 basis point terminal rate addition by this December has really upset the markets, but it's orderly. Meaning markets are reevaluating or revaluing equities, and the VIX goes up, but in an orderly fashion. It's not one of these capitulation moves where the VIX goes up 10 points or 50 to 100% in a 2-day period. So that's kind of what I'm seeing going on right now. What I want to do is shift the screen. So let me just move this over here for you guys. Let's get it over here to the E-mini S&P 500 futures. And then what you're going to see over here is just how ugly the charts look. We are in a bear market chart. All right. I mean, there's no other way to say it. It is a bear market chart here. As you can see, the 50's below the 200. Both the 50 and the 200 have a downward vector to it. You can see my support zone here, my resistance zone in light blue. We're sitting right at the bottom of this support zone. It looks like a hammer candle, which suggests a little bit of a bullish action early in the week leading up to the Feds. I would not be surprised to see that. But you can see we're at 41.74 on the 13th. 4 days later, we're sitting at 39.02. All right. So that's about 190 points, 180 points. just really ugly, really ugly, ugly, ugly. A couple hundred points, really. Actually, it's more than that, right? 300, almost 300 points in just a week. Really ugly. So that's kind of where we're seeing this. You can see the 50 EMA. We're well below that. Again, bear market chart. You can see here that my Elliott wave count is suggesting the Elliott wave is going to move below our lows that were made on 17 June, which were at 36.39, and we can go lower. Okay, the PE ratio around these levels are around 16.5, and I think fair value of the markets, given what we've got right now, is probably 15.75 to 16. So that would suggest taking us down to the 3600, 3550 area. That's what I would see over the next 60 days. All right. And then we'll have a pretty good buy. You'll see a lot of buyers step in. Any rally here is a sell the rally kind of thing. Sell the rip, I guess is what people say. And of course, if we look at NASDAQ, you can see NASDAQ also well below the 50 and the 200, both vectors pointing down for both those indicators. You can see we're right at the bottom down here of this range. Again, it's an Elliott wave 3. You can see the Elliott wave 3 projection is suggesting we're going to take out the lows we made on the 16th of June with the NASDAQ 100 futures, right? And it was down 34% on 16 June, okay? And if we look at the Dow, again, with the Dow, same thing, both 250 EMA vectors pointing down. You can see a hammer on all of these. This would suggest a bounce on Monday and Tuesday. Elliott wave 3 is projecting below the 2022 low. So all the Elliott wave count is suggesting we're going to go lower. Okay. Doesn't mean that's what's going to happen, but it does suggest we're going to go lower. Not without a little bit of a rally. So if it does get a rally, then you may want to be tightening your stops if you're long, or using it as a way to reduce some of your position or set up for more shorts to the downside. Okay. And that's a little bit about what I'm seeing here. If we come in, let me see if I can find it on here. If we can find the Russell futures right here, you can see here, same thing. Downward vector on the 200 and the 50 EMA. You can see we're down here. You can see this is the only one that's a little bit different. The Russell is holding up a little bit better, even though year to date it's worse. We've already had almost, I wouldn't call it a capitulation, but this is a 3, 4, 5 leg that would suggest that the downside on June 16th has been made. So we're getting a little bit of a dichotomy between the Russell and NASDAQ S&P. So, and that's been the way it's been all along with the Russell. And remember, the Russell is small and mid cap. These companies typically are less affected by a stronger dollar and international currency swaps and things like that because most of their revenue is done in the U.S. So let's just see how this thing plays itself out. But I think we could make new lows in most of the indexes, possibly not the Russell. Okay. And of course, if we come down and we look at the VIX, you can see the VIX here. Again, just orderly move higher. We're still in this light red zone here, but danger zone. Typically, when you go over 30, in fact, my Elliott wave count is suggesting mid 30s. So if we have a little bit of a minor capitulation low after the Fed's next week, going into the end of September, that could take us down and give us new lows, which would move the VIX up over 35 or 40 momentarily. And if that happens, that'd be a great time to get out there and sell some puts in the index, SPX. That's what we would be looking at doing. Not sure if it's going to make it that low, but that's what I'm looking at. And if we look at the front month skew in the VIX, you can see here it's fairly flat. We're in the red. We're in a backwardation term, which is what you would expect, but not by a lot. Okay. And if we look at the back month skew, which compares September and October, you can see here we're still in the green. So again, this is an orderly move lower in the markets. I don't see a lot of fear, although we do get a bid in the VIX and it is moving higher. I don't see that fear that is normally associated with the markets down, about 20% bear market territory or 25% in NASDAQ. I just don't see it giving us that kind of crazy move right now. Okay. Let's look at treasuries. If we look at the bond market, well, I still think interest rates can go a little bit higher. You can see the bonds made a new low right over here. right? That level right there. That was the prior low right here. Excuse me, right here. I had it called out. I am calling for a lower low. Um, I was looking at, and let me just put this on here. I don't know why this doesn't stay on. Let's just put it on here like that. I'm calling for bonds to move a little bit lower here. You can see the projection is way down in this area down here around 124 to 122 for the bonds. That would mean TLT is going to go lower. Interest rates are going to go higher. And if we look at the rate environment, if we look at the 10-year, which is what I'm tracking more of, you can see here that, let's just zoom it out a little bit. You can see the 10-year on the 16th hit a high of 3.49. So that was a new official high for the 10-year. But we're in this zone here. So if I were to kind of zone it out, it looks something like this, right? We're in that kind of zone right there right now. But we did hit a new high on Friday. We sold off just a little bit. But I think interest rates, I'm projecting back up here a little bit over 3.8, right? If I were to put this in here like I did with the bonds, just to project, let me just do a projection up here. It's suggesting you can get over 4%. And in fact, that's what I just said earlier. The Fed Fund Futures is projecting a terminal rate by December of 4 to 4.25%, which takes us right up into this area here by the end of the year, which means bonds are going to go lower, right? And rates are going to climb. So that's a little bit about what I'm seeing here on this. If we look at currencies, you can see the dollar down just a little bit on Friday, but you can see the dollar hit its high over here on September 7th of 110. We're going to be running here. I believe the dollar is within a month or two of starting to roll over. And in a contrarian fashion, I can see the euro getting stronger. Not right now, though, because if we look at the euro, euro is showing a little bit of strength, but it's kind of scraping along the bottom here, right? I want to see the euro get over the 50 and hold it for at least 2 or 3 days. And to me, that would be a good little rally that you can run into and see if the euro can run up to the 200 EMA, which is at 107. All right. So one thing that can get the euro up very strong, very quick is if Russia and Ukraine come to some kind of truce, right? And they come up with some kind of settled agreement. Just wording in the market of that would move the euro up probably a full point, 1.1 from 1. And move the dollar down a full point from like 110 to 109. So I could see that as a way to really move it, but I wouldn't count on it. Okay. If we look at the British pound, that one is, we haven't seen lows like this in 20 years. We're just taking out my lows and we're moving down. I think the British pound is going to start to bottom around here. If the crisis comes to an end in Russia and Ukraine, both the pound, well, all the currencies in Europe will go up, the pound, but the euro will go up the most, I believe. Okay. And if we come down here and look at gold, it was up on Friday, right? But if you look at it, we come right down here, made new lows, and you guys know my target with gold. My target was down here, right around 1600. We came down to 1661, okay? And I put that target down here when gold was up here around 1750, 1760. And the target looks like it takes us out to November, December timeframe. All right, that would be the target. If we get down here, then I'll be interested in looking at longs. And the same thing with silver, right? Silver had a good day on Friday as well. My target for silver was down here, but it may have already bottomed. All right. We got that divergence there, and we may have bottomed. You can see it's starting to recapture its 50 EMA and consolidate over a longer period of time. So that could be a positive to me. If we look at copper, which is more reflective of the global community, my view for copper is for it to continue to come down. This is just a consolidation just south of the 50 EMA before it rolls back over again. Okay. That would be the way I would see that. And then, of course, we come down here and look at energy. I think energy is going to settle in the 80s. You can see right here, we're near giving up the profits in the oil futures market for this year, right? But and the 50 has now crossed the 200. And typically that cross area turns out to be a resistance point. It's like a magnet, and it can attract price action to that point. But I do believe that, and for our members, we got a way to trade this very nicely, very simply. But for now, I think it's going to stay in a range bound in the 80s. Okay. And the one that I like is Nat Gas, but it fell really good on this past Friday. It just fell a lot. And as I was telling our members, natural gas has a hard time holding these high levels like this. So buying a put in this makes a lot of sense. I think you could still buy a put in this. I think it's going to come back down into the low sixes, even though we're supplying Europe. I think if we have a soft winter or a warmer or a milder winter in Europe, then you'll see nat gas come down even more and test these lows over here at 5.5. Okay. Now, the only monkey wrench in this could be hurricanes and hurricane season here that kind of kicks off this month of September through November timeframe. We'll see if that does that. But right now, I think near term is neutral to slightly down in that gas. Okay. All right, everybody, that's kind of where we're setting. Members, I'll go through some interesting stocks that look good to me as we move a little bit lower. And we'll take a look at some of the agricultural commodities and some others as well. All right, everybody, have a great weekend. Members, I'll see you this Sunday evening at 8 p.m. for our weekly market watch. If you're not a member, I highly encourage you to come in. We're doing well. We're well up on the markets this year. I think next year is going to be even more interesting for us. Okay, everybody, have a great weekend. Take care now. Ciao.